Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well, and in the video today we're going to be reading on what are negative interest rates. So it's saying here the Bank of England has taken another step forward to add in negative interest rates to its crisis fighting toolbox. It's given high street banks 6 months to operationally ready for them. Policymakers stress that this did not mean that sub-zero borrowing costs were imminent or indeed in prospect. But what exactly are negative interest rates? And could a world where savers are penalised and borrowers rewarded end up doing more harm than good? What are negative interest rates? The term interest rate is often used interchangeably with the Bank of England's base rate, described as the single most important interest rate in the UK. The base rate determines how much interest the Bank of England pays to financial institutions that hold money with it, and what it charges them to borrow. High street banks often use to determine how much interest they pay to the savers, as does what they charge people to take out a loan on a mortgage. Bank of England usually lowers interest rates when it wants people to spend more and save less. But it also does push some people to invest more than hold cash. But it also doesn't make people spend more because they realise they're losing their purchasing power. So it does give people more incentive to go out and spend more. It cut them to a fresh low of 0.1% in March 2020 to try to stimulate the economy amid the coronavirus pandemic. In theory, taking interest rates below zero should have the same effect, but in practice it's a bit more complicated. After all, why would anyone pay to stash money in a savings account or lend someone money when they can just keep the cash at home for free? Well, there is not enough physical cash in the system to do a one-to-one coverage for a start, as well as technically they are really in a way negative already, because if interest rates are at 0.1% and if inflation's officially from the Bank of England at 0.6%, that means that you're at a negative interest rate of 0.5%, but it may not be officially on paper, but that's what it feels like. So what might just happen now? The Bank of England's number one job is to keep prices across the economy rising steadily every year. This is known as the Bank of Inflation's target, which is set at 2% by the government. Inflation measures how quickly the cost of living is rising, and measured by the Consumer Price Index (CPI). It stood at 0.6% in December, up from 0.3% in November 2020. Inflation jumps to 0.6% Christmas in lockdown. While low inflation means prices are rising quickly, and it remains low for too long, bosses start factoring that into pay reviews. This can dampen consumers' confidence in spending. Central banks have been cutting interest rates to spur inflation for years, but as rates approach zero across the developed world, a handful went a step further. Sweden, Switzerland, Japan, and the 19 nations of the Eurozone all took interest rates below zero. In Switzerland, negative interest rates would also help to discourage investors from pouring money into the country during times of uncertainty. Well, they could probably made you to invest in foreign countries such as America or other foreign nations that don't have negative interest rates, or if they're getting they're in a tax sheltered account, they could just reinvest for dividends. If that is the case, British savers have already seen their returns dwindle in recent years. The average UK instant access account pays 0.12%, according to Bank of England, while accounts that require you to lock your money away currently offer an average return of 0.51%. In countries with sub-zero interest rates, commercial banks have passed them on to big companies. However, the evidence suggests that there is a very high bar to pass the pain on the ordinary savers. Christer Neiman, chief economist at Swedish lender Handelsbanken, says charging savers to put money in their own account is seen as taboo in Sweden. She says competition is fierce and households are ready to move their money to another bank, so nobody wants to lose business. Swiss banks UBS and Credit Suisse only impose negative interest rates on deposits of more than 2 million Swiss francs, which is probably about $2 million probably, roughly. I think it's about 1-to-1 coverage. In Germany, where some banks impose charges on deposits of more than 100,000 euros or 90,000 pounds, some people have started stashing their money in vaults and maybe gold as well, as you got pictured there, some gold. According to Germany's central banks, physical cash holding by families and businesses have almost trebled to 43.4 billion since the European Union Central Bank ECB introduced a negative deposit rate in 2014. But David Oaksley at Capital Economists says there hasn't been a wider shift towards cash because most people still prefer the security and convenience of keeping it in the bank. But if it's in an investment account and if it's monthly, every month or quarterly, you buy more stock or more stock with your dividends, then you should be able to reduce the pain of negative interest rates. Putting it in a vault runs the risk of money either being lost or stolen or damaged. He says bank deposits cannot catch fire, but bank notes can. And what about the borrowers? Negative rate mortgage already exists. In 2019, Danish bank Jyske announced that it would effectively pay borrowers 0.5% a year to take out a 10-year loan. James Pawnee, an economist at HSBC, says this is only possible because of the nature of the mortgage market. That can't be sustained for long periods of time. It just does not make sense. Paying someone to take a loan from you really doesn't make sense to me. When someone in Denmark applies for a home loan, Danish banks act as a middleman between potential borrowers and investors. In Denmark, the banks don't take the hit, investors do, says Mr. Pommery. Banks are then charging higher product fees, so have actually made money off of this. But negative rate mortgages are unlikely to be offered in the UK anytime soon. The UK interest rates were slashed to 0.5% in March of 2009, so some time ago. Some borrowers thought that they could be in line for a payment. Around 1,500 Cheltenham and Gloucester customers have a mortgage that tracked 1.01 percentage points below the Bank of England's base rate, but any prospect of a windfall was quickly dashed when financial regulators described interest payments as a one-way obligation on the borrower. In a letter to UK banks bosses, Sam Wood, chief executive of the Prudential Regulation Authority (PRA), said some lenders would need up to 18 months to make permanent changes needed to deal with the negative interest rates. While short-term fixes could be implemented within 6 months, upgrading systems not built to deal with negative Bank of England base rate would take longer, especially for some mortgage customers. Banks say that they would find it easier to explain the implement changes to being corporate clients because many already had international experience with negative rates. What are the side effects of negative interest rates? Negative interest rates hit banker earnings by squeezing the gap between the money they make and on loans which they have to pay to savers. If not passed on to customers, negative rates would hurt banks' profitability, especially at a time when they are expected to be hit by crisis-related loan losses, says Diane, chief economist at the official monetary and financial institution form OMFIF. Negative interest rates pose a particular challenge to building society, which hold around of every 5 British pounds savings accounts. While commercial banks can access cheaper borrowing by tapping financial markets, building societies must raise at least half of their funding from individual savers. So that's quite an interesting thing. We'll have to wait and see what happens. Personally, I don't think it'll be a very good thing if we do actually go officially into negative interest rates, and then add on inflation on top. That means your purchasing power is going down, as well as you're having to pay a fee for holding your money in their bank account. In your bank account, sorry. That totally does not make sense to me. But anyway, I hope you found this video useful and informative. If you have, then please feel free to subscribe to my YouTube channel, and clicking the bell notification button gets you notified when I release a video, and I look forward to seeing you all soon.